right, making you this quick video. So basically, I'm going to tell you how I tell my friends. A lot of people want to know, they want to get into the market, they want to buy. Um, so what happens is you would not know. You want to have an idea where to buy. That's key. You definitely don't want to buy over here because obviously look what happened. You don't want to buy over here because it would fall off and so forth. You and you know a lot of people just have no clue where to buy. So to keep this simple, there are obviously tools that aid you in making a decision where to buy or sell. Okay, so I'm going to keep it super simple. One of the best tools that I like, even though we got thousands of tools, it's called a simple moving average. It's actually one of the oldest tools in the market that people have used, yet it's one, in my opinion, is one of the best. And it's funny because you'll have people that do trade that use no tools. I kid you not. I got a buddy of mine. He makes freaking tons of money, and he uses no tools. So everybody has a different skill set. I am definitely that's not my way of trading, but hey, there's all types. So let's say right now, what is this tool? This tool is going to measure the last 9 periods, and I'll explain to you what that is. Right now, I have it set at 9 because that's the default. So what's 9? Here's what happens. This is the low of the bar. Actually, let me just put it as candles. Most people recognize it as candles. So this is a candle. At the moment, it represents 1 day of action because you can have, candle 2 represents 5 days, 20 days. I mean, sorry, that's, represent a minute, 5 minutes, 15 minutes, 4 day, whatever, or you make your custom if you want. But for now, this is a daily action. So the NASDAQ is up today. This is the NASDAQ basically, or we're going to call it the NDX. Well, it's up. And basically what we're saying is, look, this is the low, this is the high. We're going to take the average of the low and the high for the last 9 bars. So what happens is we're going to count 9 bars back and take the low and the high, take the low and the high, and so forth. And we're going to, like a spreadsheet, you just basically add up and you divide by 9 days and we plot it. And we're going to say that the average price for the last 9 days is $9,696, and we plot it in a line. So one way of looking at this is, okay, where do I get in? Where do I get out? Pretty simple. You can say, listen, whenever the price action is above the blue line, which is the 9-day moving average, you get in and buy. If it falls below, you get out. If it falls below, you get out. Obviously, the NASDAQ is so strong that it constantly has a tendency of gravitating to this line. And, over here, you would have just gotten out because it closed below the 9. You close, and then the stock drops to hell. Depending on the stock, let's just say we'll get into Lululemon in a minute. I told you I would get you Lululemon, but MU, let's say Micron. Hold on. So this one has more of a tendency of fluctuating. Notice, so you can basically, if you're trading, this will keep you on the right side of the trade. Now, some people, like I said, you can say, let's say this particular a company is really, we're going to call it volatile because that's really the word, where you have a lot of action going up and down, and you want to, you don't want to be checking this daily. So one of the things you can do is set a longer period. You're going to say 20 moving average. I like to add another one, simple. I'm going to say 50. Let's make it a little thicker. So one of the things you can do is, this is the longer period, which is 50, this red line. And now I made the blue line into 20 period. So what ends up happening is this. Once you close above, it's kind of the same thing. We call it a cross. Once it starts crossing and the stock gets into this area, it's a decent buy. And it filters off a lot of the, let's say, volatile action. Even though over here you had a lot of volatility, for the most part, if you were to look at your wins versus losses, you would have more wins if you're betting up. Even though it gets volatile here, As long as it doesn't break below the red line, you stay within the trade. That's really what it is. So, pretty much on this one, you could have stayed on the trend all the way to the bottom instead of getting out of the blue line. It also acts as one of these things where, let's say, I'm going to use this exact line as an example, where a lot of people like to get into the blue line. Once it gets read by the blue line, they feel there's going to be a rejection downward, let's say, because this is a downward trend. So one of the things, and we'll talk about shorting in a minute, one of the things you can do is, instead of, let's say you had $1,000 to bet down, instead of putting your $1,000 here and this thing keeps on going up, what you can do is put 500 here, then 500 here, and you definitely know that your hard stop, meaning that you're definitely not going to spend or allow the stock to get above this to lose extra money. So your hard stop, and you would actually lose like no money here. So it would basically, you would come in, take in 500, the trade wouldn't work, it keeps on going up, you put your other 500, now you're invested 1,000, and the trade definitely works, and so forth. And here's the same thing, you put 500 bucks, it works, it doesn't get to this line, but now what ends up happening is at some point in time it gets to the red line, and at the red line you would scale in your other 500 bucks, but during this time you're still making money. That's the key. It's management of risk. Trading, that's all it is. I know many years ago I blew tens of thousands of dollars having no clue, but it's just trade management. If you understand what your risks are and what your trades are. Example, same thing here. You get in 500 bucks, it takes off. You get in, you can either put another 500 bucks or get out, or just wait for it to hit the red line. Once it hits the red line, you get in your extra 500 bucks and so forth. All right, so enough of trading. That's keeping it simple. Now, shorting a stock. To explain, shorting a stock is this. Let me come here. Okay, grab a tool. So let me actually see a white spot. So shorting a stock is this. Let's say Micron, which is what I was using right now, the stock. Micron is, well, let's just say it's $100. Okay. I got a feeling it's going to start going down. Okay. Just like we had that area. We're like, okay, it's going to go down. We want to take advantage of that. So you go to your brokerage house, and your brokerage house, let's say, is Charles Schwab or TD, Ameritrade, or Fidelity, and so forth, whoever it is, and you actually will borrow stocks from them. These stocks are in people's portfolios, like your portfolio, whatever. Let's say you had 500 shares in your portfolio. They'll just pull it out. Believe it or not, when you open an account with the brokerage firm, in the small print, you agree to allow your brokerage firm to reassign the stocks, as long as, remember, you make money when you cash it out. So what ends up happening is they'll just borrow it for a day or two, and they'll just put back the stock, because you're going to get paid on whatever the price action is the day that you pull it out. So what ends up happening is I'll go to them and I'll say, listen, I'm going to go and borrow. Okay, so the stock is at 100 bucks, and to keep numbers simple, I'm going to go and borrow 100 shares. Okay, so what ends up happening is this. I will go ahead and sell at the market. Sell it. When you sell something, you collect money. Okay, so we're going to collect the premium, or the money that we collect for selling this. So that in itself is going to be 10,000 bucks. So we're going to collect $10,000 upon selling this. That money technically goes to me because I sold those shares, 100 shares. Now the stock starts going down, and let's say for example's sake, the stock goes to 50 bucks. Okay, so now I will buy to close back 100 shares, but now it cost me $5,000. All right, so what I did is I made the spread. The brokerage home basically will now, when I buy this back, I will basically give them back their stocks, because it's the stock. And remember, it's worth $5,000 because the stock is worth 5,000. I don't collect this 5,000 because that's the value of the stock. So I give it back to them, and they put it back in your account. But that's called shorting, where you borrow the instrument, you sell it at the market value with the hopes that it goes down. Obviously, you can take tremendous losses. I can wake up tomorrow and MU, somebody will say, hey, listen, we're buying MU for $200 a share. I just got screwed because at $200 a share, I bought it, I collected 10,000, but now I owe the brokerage house 100 shares that are worth $20,000. And I got to pay them, I got to give them 100 shares plus $10,000 more. Right? The 10,000 I collected plus the 10,000 more. So you do run a risk if you have no clue what you're doing. You run a risk, but that is betting down. So if you think the stock is going down, you short the stock. So now to go to my example, one of the ones that I told you, I think it's bananas. Let me get rid of this. Get rid of this. Is Lululemon. They sell athletic wear. Beth, I'm pretty sure would know what this is. So what this is just yoga pants, as I like to say. During the pandemic, which was February and March of this year, this thing, here's the thing about this stock. This thing was betted up, I'm going to say, by the majority of the millennials and FOMO. It took from, okay, so yeah, I got the line. From 2017, let's just say November 2017, all the way to February 2020, it went up 350%. You can see it over here. You're going to see the percent sign. It was up 357%. Okay. From the low of March of this year, which was 50 days, it went up 150%. That is bananas. What took, I don't know, approximately 3 years, it went half of that distance in 50 days. So that value, I mean, there is definitely during this time, there was no gyms open. I don't see people buying $60 yoga pants just to work out at home. I just don't. Sorry. People are doing capital preservation during that time. Also, when you look at the value, not the valuation, but one way of reading this is the PE, which is price per earnings. Basically, that's a multiple. So let's say your company did $1 million net and somebody paid you $1 million for the company. You're doing one multiple because it's 1-to-1. In other words, they're advancing you the net of 1 year. This is 64 times. It's expensive. Why is it expensive? Because Nike, which everybody knows Nike has a PE of 38. So you're telling me that on paper, these people are worth more, not as far as net worth, but in the sense that you're going to compensate them. You're going to pay them 64 times. I mean, these people don't have any licensing agreements, like let's say right now, the Hard Rock Stadium, you got licensing agreement. You don't got Lulu Stadium and none of that shit. You just don't. None of that. So that is one reason why I'm like, this is too overvalued. Another one is, here is a little quick study. Where the hell is my chart? Line. Let's make it into a line. And then I want to go and compare this stock with Under Armour. Oh yeah. Under Armour. Okay, give me 1 second. Let's go to weekly. That's the wrong Under Armour. All right, give me 1 second. There we go. All right. So if you look at this, basically April's 1 year, 2 years. It's one of, well, here's the thing. Under Armour had a high and it had a similar PE back then of 400+% from kind of the same thing here. We have almost a very similar 466%, 466. This had a high PE ratio. So in other words, the past always repeats itself. That's kind of like what I'm trying to get at here. And it mimics itself. You know, it had a high rise in the same time frame where we look at the same time frame from here, more or less. And you're comparing what happened in the past, and Under Armour lost because of the PE, went all the way to 60. So I'm kind of betting, and there's other things too, that Under Armour, I mean, Lululemon probably in the next, let's just say, from here is 1 year, 2 years, almost 3 years. You can say in the next 3 years, it's going to go down. So you could probably take a bet and say that it's going to repeat. Also because the numbers are very similar. Not that I'm going to get into it into this video. But so that is what we're looking as to short. Now, can you short stocks? You can. Stocks to me are a little tricky. So one of the things you probably could do is short an option. An option is where somebody is going to say, listen, we're going to assign you, give you our shares if you meet the criteria. So one way you can do is say, listen, in the next 10 days, this is a 10-day option. You're going to pay, it's $14 a share times 100 because these things come in 100 bunch. You're going to buy for 1,500 bucks. So it's, 15 times 100 for 1,500 bucks. You're going to buy the option that if the stock goes 320 or below, because you're buying in this direction, 320 and below, so it'll be 320. 320 is your strike price, meaning the price you want to take the shares at. Actually, let's say it's 317 to be exact. 317 minus what you pay for that option, which is $15 and $15 just made. So at 302, if in the next 10 days the stock goes below 302, whatever it continues to go down, you're going to keep the difference. I basically bought a leap. A leap is when you go out like 500 days. I bought a leap and I didn't buy one that expensive. There's ways of going around this, but and so you can buy a leap and say, listen, if it goes in 2 years, remember we're probably thinking it'll go 60. So you can buy a leap somewhere here for 1,900 bucks. Um, somewhere 1,900 bucks. That's what it would cost you. And pretty much, if it goes below that in the next year, you keep the difference. What are you keeping? Well, let's just say Under Armour. Uh, let's just say 3,200 bucks that I got it here. So if it goes from here in the next 2 years and it gets to 50, 60 bucks, so you'll double kind of your money. There's ways of doing it a little better, but that's kind of, make 2,200 bucks on whatever. I wouldn't buy that. Why is it 70 put? That is just crazy. $175. If it gets to there, you make about 8,000 bucks. You would be paying. Yeah, that's expensive. You would have to finance that. We're not going to get into that. But anyway, you can bet down. So that's what I wanted to explain to you. You can do with options. You can sell stocks. You can bet down. Now, us on the market, showing you what I believe will happen now. Uh, and VIX. Where's my VIX view? Oh. All right, so there is something called a VIX, which is where people buy insurance. Basically, you know how I bought that option to go down? People buy options to secure, or they buy insurance to let's call hedge the portfolio, protect it. You don't want to lose money after you made money. So what this does is it takes into account the 9-day insurance, the 30-day insurance, 90-day, and 6-month insurance. So what happens is when people start panicking, you'll notice that the insurance within the 9 days, meaning because they're They're going out and buying insurance really quick. I built this to tell me every time that they started buying heavy insurance, the market would normally turn down. See here, I got red, and the market would come down a little bit. Here I got red, and the market would come down. And yet, when they would relax and they wouldn't buy no insurance, the market had a tendency of rallying. Same thing happened over here and over here. The market just kept on going up because they relaxed on the insurance. This was the, but what ends up happening is we're getting a cross again. And this black one is going over, it's going to cross probably just like it did here, where people are buying insurance in the near term, the 9-day. It's something that I look at that kind of tells me that maybe this market is about to roll over. So, with that said, where's my plane? Let's just do it here. And SPX, the S&P. Let's get rid of this crap. So this is the S&P since the 1930s. And the market has a tendency of doing trend lines. Notice it just does trend lines. So here was correction from 2000. 2000, the stock dropped 51% from the high to the low. It dropped 51. In 2008, it dropped from the high to the low 57%. And then we do like a little quick study. The market went up, and right now you're looking at from the high to the bottom, a 52% correction would bring you to this line here. Notice that we only had dropped here. So that means we got to probably drop even lower. At this time, you could put in your 401k, and there is a high probability. Again, everything in trading is mathematical math, probability. There's a high probability that it'll go up. And reason for that is too, let's go with the RSI. This measures strength in the market. It's just like when you're working out and you're lifting weights. You can lift weights, but as you're getting towards the end of exhaustion, you know you're going to fail at one point. So here is, let me put it for you on weekly. Hold on a second. Weekly. Weekly, and we're going to go 20 years out. All right, so every time the market failed, think of it again like working out. The relative strength indicator, RSI, measures strength. So the market made a high, and as the market makes highs, you know, notice over here we have like a downtick where it's losing kind of strength. Actually, let me see if I do this a little better on the monthly. Okay, and let's get monthly Scomax available. All right. All right, so even though the market made highs, it came down, came down, came up, came down. Notice that right now we're almost on a downtrend, even though the market is making higher highs, meaning you notice that the market today is high, but look at the strength of the market. It has not cracked up. In other words, long term is that this will, if this line gets to this blue line, we may turn around because we're not cracking over it. The moment we crack over it, notice that the market starts rallying. The moment we crack over it, the market starts rallying, and so forth. And this is the time factor. This took about 2.5 years to go down. This took about 3 years to go down. So my estimation is the same crap this way, where I took an average. My thing is this can bring us all the way to somewhere 2020, the ending of 2022. But again, if we don't crack above it and we fail, the market will roll over and it will just, you know, basically fall. These are just points of inflection that I have where to look for, where I can buy to get small bounces. Um, but for the most part, that's really it. So we're looking at market is going through the roof, but it's a fake out where a lot of people will buy thinking the market is fantastic, and I don't see it. Anyway, that's it. Let me know. Bye.